Okay, welcome back. Let's dive right into this explainer tailored specifically for all of you future PIPFA and DAO auditors out there. Today, we're going to completely demystify Chapter 4 of the Financial Audit Manual, or FAM. Listen, if you want to guarantee the integrity of public sector audits, mastering this framework isn't just about passing your exams. It is the absolute bedrock of your entire professional career. We're going to break down the entire audit cycle step by step, making all that dense technical terminology crystal clear.
So here is our roadmap for today. We're covering the 6 definitive phases of the audit cycle: general audit planning, activity and resource planning, fieldwork, evaluation, reporting, and finally, follow-up.
There's this fundamental truth straight from the FAM itself. Efficient and effective collection of evidence depends on a clear audit plan. Seriously, a catastrophic audit failure almost always starts with poor planning. You can't just jump in and start checking numbers, right? You absolutely need a roadmap.
Think of the whole process as a logical downward waterfall. Everything builds on the step right before it. You literally can't execute your audit programs if you haven't assessed the risk first, and you definitely can't issue a report if you haven't concluded on your results. Keep that continuous sequential flow in your mind as we go through this.
Right, let's start at the very top. Phase 1, General Audit Planning. This is where we set the overarching strategy.
During this general planning phase, you are strictly looking at the big picture. According to the manual, these critical decisions are made by the senior audit members. First, you're systematically establishing your objectives and scope. Then, you've got to actually understand the entity's business. You have to know how they operate before you can audit them, right? And finally, you assess materiality, plan precision, and audit risk before you even think about diving into the granular details. This sets the boundaries for the whole project.
So when we divide the audit into components, what are we actually hunting for? You've got to memorize these specific financial audit objectives because they literally define what constitutes an error. You're checking for validity, meaning existence, completeness, regularity, which just means does the entity actually own or owe the component, valuation or measurement, and finally, proper presentation. If a component fails any of these criteria, well, you've got an error on your hands.
Moving right along to Phase 2, Detailed Activity and Resource Planning. This is where theory turns into actionable logistics.
Listen, so many students mix up these 2 planning phases, but it is absolutely crucial to get the distinction right. Phase 1 is your overarching strategy, setting those high-level parameters like materiality and audit risk. Phase 2 takes those decisions and uses them to draft your specific audit programs, figure out how many auditors you need, set the budgets for out-of-pocket expenses, and schedule out the timing. Think of it like this. Phase 1 is the what and why, and Phase 2 is the who, when, and how.
Okay, resources are planned, programs are written. Welcome to Phase 3, Fieldwork. Let's gather that evidence.
This is where you literally roll up your sleeves and get into the trenches. You are executing the exact procedures listed in your carefully crafted programs. Your one and only goal here is to obtain relevant, reliable, sufficient, and convincing evidence. But hey, if it's not documented, it didn't happen. You must meticulously record everything in your working paper files. And to keep the project on track, you've got to log your daily time and explain any variances from your audit budget.
Fieldwork is done. Now we transition into Phase 4, Evaluation. It's time to make sense of what we just found.
Error evaluation in the FAM is not a guessing game. It is highly structured. You build your conclusions from the ground up. Stage 1. You calculate the most likely error and the upper error limit for every single individual test. Stage 2. You roll those up to reach a conclusion on each audit component. And Stage 3. You aggregate the whole thing to reach a conclusion on the financial statements as a whole.
The FEMAS is incredibly strict on this point, stating that considerable professional judgment is required here. Why? Because an incorrect judgment call at this stage could literally lead to a completely wrong opinion on the financial statements. No pressure, right? That is exactly why a rigorous, detailed review and approval by senior directors is totally mandatory during evaluation.
We are almost at the finish line. Phase 5, the reporting process. Time to issue the opinion.
Now here is a golden procedural rule. You never blindside the entity. Before you publish anything, you have to sit down and seek management's agreement on the extent and cause of any monetary errors, compliance violations, or internal control deviations. This clearance process is what ensures your findings are factual, fair, and totally objective before they go on the public record.
After clearance, you draft that final opinion. When you formally issue the audit certificate, you're officially validating some incredibly critical points. You're stating whether the financial statements present the financial position fairly in all material respects. But remember, for public sector audits, you are also verifying legal compliance, checking that the money spent was actually applied for the purposes authorized by Parliament and correctly booked to the relevant grants. It's a massive responsibility.
And finally, Phase 6, follow-up. This is how we ensure real accountability.
You might think handing over the report means you're done. No way. Follow-up is a non-negotiable part of the job. We haven't succeeded unless the deficiencies are actually fixed. We have to return at a later date to see if management corrected those monetary errors and implemented our recommendations. And if the matter is serious, we report those follow-up results straight to the Public Accounts Committee, or PAC, for ultimate accountability.
So, as we wrap up this explainer, I want you to think about how this all connects, because it really is an audit cycle. How does the follow-up phase actually impact your next assignment?
Well, the cycle is a continuous loop. All those unresolved issues and follow-up data bleed directly into the general planning phase of next year's audit. Checking the entity's corrective actions literally determines the most likely error and the opening balances for your current year. The end of one audit seamlessly becomes the starting point for the next. It's brilliant.
And that is Chapter 4 of the FAM in a nutshell. For you future PIPFA and DAO professionals, mastering this framework isn't just an academic exercise, it is how we safeguard public trust. So the question I want to leave you with today is, now that you know the complete framework, how will you put these 6 rigorous steps into action to guarantee the integrity of your next public sector audit? Keep these concepts front and center as you head into the field.